Have you ever experienced that moment when your entire world collapses in a single conversation? That nauseating instant when you discover that the people who raised you have chosen to destroy your future to enable someone else's irresponsibility? My name is Alexandra Sterling, and 3 years ago, my parents handed my $750,000 trust fund to my gambling-addicted brother to cover his debts, leaving me with nothing for my MBA program at Wharton. What happened next would transform me from a betrayed daughter into the CEO of the community bank that now holds their mortgage, their business loans, and ultimately their financial future in my hands. Before we jump back in, tell us where you're tuning in from, and if this story touches you, make sure you're subscribed, because tomorrow I've saved something extra special for you. The morning that shattered my reality began like countless others in our family's sprawling estate in Greenwich, Connecticut. I was home for spring break during my final semester at Yale, where I had maintained a perfect GPA while double majoring in economics and international business. The acceptance letter from Wharton's MBA program sat framed on my desk, a symbol of the carefully planned trajectory that would launch my career in investment banking. I had awakened early that March morning, excited to discuss my post-graduation plans with my parents over breakfast. The trust fund that my grandfather had established for me when I was born contained enough money to cover my entire MBA program, provide living expenses for 2 years, and still leave a substantial sum for launching my career. This financial foundation had been the cornerstone of my academic and professional planning since I was old enough to understand its significance. The trust fund represented more than mere money. It embodied my grandfather's belief in education, his commitment to empowering the next generation, and his specific faith in my potential to achieve extraordinary things. He had been a self-made banker who built Sterling Community Bank from a single location into a regional powerhouse before selling it to a larger institution. His stories about building something meaningful from nothing had inspired my own aspirations in finance. My parents had always spoken of the trust fund as my inheritance, my ticket to opportunities that would set me apart from my peers. They had encouraged me to dream big, to pursue ambitious goals, to never worry about the financial constraints that limited other students' choices. This security had allowed me to focus entirely on academic excellence and building the kind of resume that would open doors to elite institutions and prestigious career opportunities. Walking into the breakfast room that morning, I found my parents, seated at the mahogany table that had hosted thousands of family meals over the years. The morning light streaming through the tall windows illuminated their faces, but something in their expressions immediately triggered an instinctive sense of unease. My mother was fidgeting with her coffee cup, avoiding eye contact, while my father was reviewing documents with unusual intensity. "Good morning," I said, settling into my usual chair and reaching for the coffee pot. "I wanted to talk about the logistics for accessing the trust fund. Wharton's business school requires the first semester payment by June, and I need to start apartment hunting in Philadelphia." The silence that followed my words stretched uncomfortably long. My parents exchanged a look that I could not interpret, but which filled me with growing apprehension. Finally, my father cleared his throat and set down the papers he had been studying. "Alexandra, we need to discuss the trust fund," he began, his voice carrying a tone I had never heard before. "There have been some changes to the situation that we need to explain." My stomach began to tighten as I processed his words. Changes to the trust fund were not possible. The legal documents were ironclad, designed specifically to prevent any modifications until I reached the age of 25 or completed my undergraduate education, whichever came first. My graduation was just 2 months away, which meant the funds would become accessible exactly when I needed them for business school. "What kind of changes?" I asked, setting down my coffee cup as my appetite vanished entirely. My mother finally spoke, her voice barely above a whisper. "Sweetie, your brother got into some serious financial trouble, the kind that could have destroyed his life, his marriage, everything he has worked for. We had to help him." The implication of her words hit me like a physical blow, but I refused to accept what she seemed to be suggesting. What does Daniel's financial situation have to do with my trust fund? Those are completely separate matters. My father leaned forward, his expression pained but resolute. We used the trust fund money to cover Daniel's gambling debts. He owed over $600,000 to some very dangerous people, Alexandra. They were threatening him, threatening Sarah and the children. We could not stand by and watch our son's family be destroyed. The words seemed to echo in the breakfast room as I struggled to process their meaning. My trust fund, the financial foundation that had shaped every decision I had made about my education and career, had been given to my brother to pay gambling, debts that he had accumulated through his own irresponsible choices. You gave away my inheritance to cover Daniel's gambling losses? I asked, my voice surprisingly steady despite the chaos erupting in my mind. It was not a gift, my mother interjected quickly. Daniel signed promissory notes. He is going to pay back every penny with interest. This is just a temporary arrangement until he can get his finances stabilized. I stared at my parents, these people who had raised me, who had taught me about responsibility and consequences, who had preached the importance of earning what you receive rather than expecting handouts. The hypocrisy was staggering. They had sacrificed my carefully planned future to rescue my brother from the consequences of his own destructive behavior. A temporary arrangement? I repeated, my voice beginning to rise despite my efforts to remain calm. I need that money in 3 months, not 3 years. Wharton is not going to hold my spot while Daniel figures out how to pay back gambling. Debts. My father's jaw tightened. You can apply for student loans like most graduate students do. Your undergraduate record is excellent, and banks will be eager to lend to someone with your credentials. This setback does not have to derail your plans permanently. The casualness with which he dismissed my financial security was breathtaking. Student loans for an MBA program at Wharton would exceed $200,000, debt that would constrain my career choices and financial freedom for decades. The trust fund was supposed to provide me with options and independence, not burden me with obligations that would limit my potential. So Daniel's poor choices become my financial burden? I asked, my voice becoming sharper. He gambles away hundreds of thousands of dollars, and I am supposed to take on massive debt. To accommodate his irresponsibility? It is not that simple, my mother protested, tears beginning to form in her eyes. Daniel made mistakes, yes, but he is family. We do not abandon family when they need help. You are strong, Alexandra. You have always been the responsible one, the one who finds solutions to problems. We know you will figure this out. There it was, the familiar refrain that had defined my role in the family since childhood. I was the responsible one, the problem solver, the daughter who could be counted on to handle whatever challenges arose while my brother received endless support and bailouts for his increasingly destructive behavior. Daniel had dropped out of college twice, failed at multiple business ventures that my parents had funded, and now had apparently developed a gambling addiction that threatened to destroy his marriage and endanger his children. Yet when faced with choosing between supporting his reckless behavior and preserving my carefully planned future, they had chosen him without apparent hesitation. "Where is Daniel now?" I asked, my voice cold with controlled anger. "He is on treatment," my father replied. "A residential program in California that specializes in gambling addiction. Sarah and the kids are staying with her parents while he gets the help he needs." I nodded slowly, absorbing this information while my mind raced through the implications of my new reality. My brother was receiving professional treatment funded by my trust fund, while I was expected to burden myself with debt to pursue the education I had earned through years of disciplined effort and academic excellence. "How much is left?" I asked, quietly. My parents exchanged another uncomfortable look before my father answered. "About $50,000. We kept some in reserve in case Daniel needs additional treatment, or if other emergencies arise." $50,000. From a trust fund worth $750,000, they had preserved less than 7% for my use while giving the remainder to my brother to cover gambling debts that he had accumulated through his own choices. "And you made this decision without consulting me?" I asked, though I already knew the answer. "You were focused on your studies," my mother said defensively. "We did not want to burden you with family problems during your final semester at Yale. We thought it would be better to handle the situation and then explain everything when you came home." I stood up from the table, my legs unsteady as the full magnitude of their betrayal became clear. They had not consulted me because they knew I would have opposed using my inheritance to enable Daniel's addiction. They had acted in secret, presenting me with an accomplished fact that could not be reversed. "I need some time to process this," I said, walking toward the door of the breakfast room. "Alexandra, please understand," my father called after me. "We did what we thought was best for the family. Sometimes being part of a family means making sacrifices for each other." I paused in the doorway and turned back to face them. "Sacrifices should be voluntary, not imposed by other people's choices," I said quietly. "And they should be distributed equitably, not always demanded from the same person." I left them sitting at the breakfast table and walked outside into the gardens that surrounded our family home. The spring morning was beautiful, with flowering trees and carefully maintained lawns that reflected decades of careful investment and attention. This beauty felt grotesque now, a facade that concealed the ugly reality of my family's priorities and values. As I walked among the gardens my grandfather had designed and my grandmother had lovingly maintained, I tried to make sense of what had just occurred. My parents had destroyed my financial security to protect my brother from the consequences of his gambling addiction. They had made this decision unilaterally, without consultation or consideration of how it would affect my future. The trust fund represented more than money. It represented my grandfather's belief in my potential, my parents' supposed commitment to my success, and my own careful planning for a future built on financial independence rather than debt obligation. Indeed, a single conversation, all of that had been stripped away to accommodate my brother's irresponsibility. I sat on the stone bench beside the fountain my grandfather had installed as a gift for my grandmother on their 40th wedding anniversary. The inscription read, "To my beloved partner in building something beautiful together." As I stared at those words, I realized that my parents had destroyed not just my trust fund, but also my faith in family partnership and shared commitment to each other's success. The betrayal was deeper than the financial loss, devastating though that was. My parents had revealed that their support for my education and ambitions was conditional, secondary to their willingness to enable my brother's destructive behavior. When forced to choose between empowering my success and rescuing him from his failures, they had chosen rescue over empowerment without apparent regret. I thought about my grandfather, who had built his bank through disciplined effort and strategic thinking. He had taught me that financial independence was the foundation of all other freedoms, that careful planning and responsible behavior created opportunities while reckless choices destroyed them. My parents had abandoned these principles to protect my brother from learning these lessons through experience. The afternoon sun was setting when I finally returned to the house, my mind clearer about the reality I faced but still struggling with the emotional implications of my family's choices. I found my parents in the library, apparently waiting for my return with anxious expressions. "Have you had time to think about everything?" my mother asked hopefully. "Yes," I replied. Simply, "I have decided what I am going to do." They both leaned forward expectantly, clearly hoping that I had found a way to accept their decision and move forward without further conflict. "I am going to defer my admission to Wharton for 1 year, I announced. "I am going to use that time to earn enough money to pay for business school myself without student loans." My father frowned. "Alexandra, that is not realistic. Even with a good job, you cannot save enough in 1 year to cover 2 years of graduate school expenses. Then I will find a way to make it realistic, I replied calmly. You have taught me that I am the responsible one, the problem solver. I will solve this problem. We could help you with the loan applications, my mother offered. With our credit and assets, you could qualify for very favorable terms. I shook my head. I will not put myself in debt to accommodate Daniel's gambling addiction. I will find another way. My parents looked confused by my determination to avoid the obvious solution of student loans. They could not understand that borrowing money to replace the inheritance they had given away would make me complicit in their decision. Taking on debt would mean accepting their choice to prioritize Daniel's immediate crisis over my long-term future. What kind of job are you planning to pursue? My father asked skeptically. I will figure that out, I said. But I want you both to understand something clearly. I will remember this conversation for the rest of my life. I will remember that when you had to choose between supporting my success and enabling Daniel's failures, you chose enabling failure over empowering success. The hurt in their faces was evident, but I felt no sympathy. They had made their choice, and now they would have to live with the consequences just as I would have to live with mine. Preparing and narrating this story took us a lot of time, so if you are enjoying it, subscribe to our channel. It means a lot to us. Now back to the story. That night, I lay awake in my childhood bedroom, staring at the ceiling as I processed the complete transformation of my circumstances. 12 hours earlier, I had been a successful student with a clear path toward an elite MBA program and a promising career in finance. Now I was someone who had been betrayed by her own family and left to reconstruct her future from nothing. But as the hours passed and my initial shock gave way to analytical thinking, I began to see opportunity within the crisis. My parents had shown me exactly what they valued and who they prioritized. This knowledge, painful though it was, would inform every decision I made going forward. I would never again count on their support or consider their interests when making choices about my future. More importantly, they had inadvertently provided me with motivation that I had never possessed before. I had always worked hard and achieved excellent results, but those efforts had been supported by financial security and family encouragement. Now I would be working not just for success, but for vindication, not just for achievement, but for independence, from people who had proven themselves unreliable. As dawn broke over the Connecticut landscape, I was no longer the naive daughter who had trusted her family's promises about shared commitment to success. I was someone who understood that I could only count on myself, that my security would come from my own efforts rather than inherited advantages, and that the people who had betrayed me would eventually witness exactly what they had unleashed through their betrayal. The trust fund was gone, but my grandfather's most important legacy remained intact. His belief that anyone with sufficient determination and strategic thinking could build something meaningful from nothing. My parents had taken my inheritance, but they had also provided me with the motivation to prove that their judgment about priorities and values was catastrophically wrong. I would show them what the responsible daughter could accomplish when she stopped solving other people's problems and started building her own empire. And when I succeeded, they would understand the true cost of the choice they had made in that breakfast room on a beautiful spring morning when they chose to destroy my future to enable my brother's failures. The battle was just beginning, but I had already decided how it would end. The weeks following my parents' devastating revelation unfolded like a carefully orchestrated demolition of everything I had assumed about my future. Each day brought new complications that compounded the original betrayal, creating a cascade of consequences that extended far beyond the simple loss of my trust fund. What began as a family crisis rapidly evolved into a comprehensive challenge that would test every aspect of my character, intelligence, and determination. The first major complication emerged when I contacted Wharton's admissions office to request a deferral of my enrollment. The conversation with Dean Patricia Morrison proved far more complex than I had anticipated. While the business school offered deferral options for students facing unforeseen circumstances, My situation presented unusual challenges that standard policies did not address adequately. Ms. Sterling, Dean Morrison explained during our phone conversation, our deferral program typically accommodates students who have received Rhodes Scholarships, Fulbright Fellowships, or similar prestigious opportunities that would enhance their eventual contribution to our program. Financial difficulties, while unfortunate, are generally addressed through our extensive financial aid resources rather than enrollment delays. I found myself in the uncomfortable position of explaining that my financial difficulties stemmed not from economic hardship but from family betrayal, a distinction that proved difficult to articulate without sounding like I was making excuses or seeking sympathy. The dean listened politely to my explanation, but made clear that deferral approval would require compelling justification beyond temporary financial constraints. What specific activities would you pursue during this gap year that would strengthen your application and enhance your future contributions to our program? She asked pointedly. The question forced me to confront the reality that I had no concrete plan beyond a vague determination to earn enough money to avoid student loans. My academic success had been built on careful preparation and detailed planning, but my parents' betrayal had occurred so recently that I had not yet developed a strategic response beyond emotional reactions. I planned to gain practical experience in the financial services industry, I replied, improvising rapidly. I believe that working in banking or investment management would provide perspectives that would enhance my academic experience and complement my theoretical knowledge. Dean Morrison paused before responding. Ms. Sterling, your academic record is exemplary, and your application essays demonstrated sophisticated understanding of financial markets and business strategy. However, most of our students work in finance or consulting before enrolling in our program. What specific experience would you seek that would differentiate your application from those of your peers? The challenge in her question was clear. I needed to articulate a gap year plan that would strengthen rather than weaken my eventual application to Wharton. Simply working in an entry-level position at a major financial institution would not distinguish me from thousands of other applicants with similar backgrounds. I'm interested in exploring entrepreneurial opportunities within financial services, I said, the idea forming as I spoke. Specifically, I want to understand how technology is transforming traditional banking and investment management. I believe that practical experience in this rapidly evolving sector would provide insights that would enhance my contributions to classroom discussions and group projects. This response seemed to resonate more effectively with Dean Morrison. That is an interesting perspective, Ms. Sterling. The intersection of technology and financial services is indeed a rapidly growing area of focus within our curriculum. If you can demonstrate meaningful accomplishments in this field during your gap year, that experience could strengthen your application significantly. We concluded the conversation with Dean Morrison agreeing to approve a 1-year deferral, provided that I submitted a detailed plan for my gap year activities within 30 days. This deadline created immediate pressure to transform my vague determination into a concrete strategy that would satisfy both my financial needs and the business school's academic expectations. The second major complication arose when I began researching entry-level positions in financial services. My Yale economics degree and academic achievements certainly qualified me for analyst positions at major banks and investment firms. But these opportunities typically required commitment to multi-year training programs that would conflict with my plan to begin business school the following year. Moreover, the compensation for entry-level positions, while competitive for recent graduates, would not generate the savings required to cover 2 years of graduate school expenses without significant supplementation. Even the most generous starting salaries in investment banking would leave me substantially short of my financial targets after accounting for living expenses and taxes. During a particularly discouraging day of research and phone calls, I encountered Sarah Chen, a Yale alumna who had graduated 3 years ahead of me with a similar academic background. Sarah had initially pursued a traditional path in investment banking before leaving to launch a fintech startup, focused on alternative lending platforms. Alexandra, she said when I contacted her through our alumni network. The financial services industry is transforming rapidly, but most of the innovation is happening outside traditional institutions. If you want to gain meaningful experience while building something valuable, you need to think beyond conventional employment. Sarah's perspective proved illuminating as she described the challenges and opportunities she had encountered while building her company. Alternative lending, she explained, represented a growing market where technology-enabled platforms were displacing traditional banks in specific niches by offering faster approval processes, more flexible terms, and better customer experiences. The key insight, Sarah continued, is that most traditional banks are constrained by legacy systems and regulatory requirements that make innovation difficult. Meanwhile, smaller financial institutions like community banks and credit unions have the flexibility to adopt new approaches but lack the technical expertise to implement them effectively. This observation sparked an idea that began forming the foundation of my gap year strategy. Community banks faced increasing competitive pressure from both large national institutions and emerging fintech companies, creating opportunities for someone who could bridge the gap between traditional banking and technological innovation. My grandfather's background in community banking suddenly became relevant in ways I had not previously considered. His success with Sterling Community Bank had been built on personal relationships and deep understanding of local market needs, advantages that could be enhanced rather than replaced by appropriate technology applications. I spent the following week researching the community banking sector, learning about regulatory requirements, technological challenges, and competitive dynamics that shaped these institutions' strategic options. The research revealed significant opportunities for someone with my academic background and family connections to create value by helping smaller banks modernize their operations while maintaining their community focus. The third major complication emerged from an unexpected source when Daniel contacted me directly for the first time since the trust fund revelation. His call came at 11 o'clock on a Tuesday evening, 3 weeks after my conversation with our parents, while I was deep in research about banking regulations and fintech applications. Alexandra, he said when I answered the phone, his voice carrying a mixture of shame and defensiveness that I had not heard before. I heard about what happened with your trust fund. I wanted to talk to you directly about the situation. The conversation that followed proved both more and less enlightening than I had expected. Daniel acknowledged that his gambling addiction had created the crisis that led to my parents' decision, but he seemed unable to grasp the full implications of how their choice had affected my future plans and financial security. I know this is a difficult situation for everyone, he said, as if we were all equally victimized by circumstances beyond our control. But I want you to understand that I never asked them to use your trust fund. When they told me they were going to help with the debts, I assumed they were using their own money or taking out loans against the house. This revelation added another layer of complexity to my understanding of the family dynamics. My parents had apparently made the decision to sacrifice my inheritance without consulting either Daniel or me, acting unilaterally in what they perceived as the family's best interests. Daniel, I said carefully, what exactly did you tell them about your situation? How did they learn about the gambling debts? His answer revealed the final piece of the puzzle that explained how my trust fund had become the solution to his crisis. Daniel had confided in our mother about his gambling losses during a family dinner, where I was absent due to academic obligations at Yale. The conversation had apparently occurred over several weeks, during which our parents had gradually understood the severity of his financial predicament. Mom and Dad were terrified that something would happen to Sarah and the kids, Daniel continued. The people I owed money to were not patient or understanding about repayment schedules. They made it clear that continued delays would have serious consequences for my family's safety. As Daniel described the escalating pressure from his creditors, I began to understand why my parents had acted with such urgency and secrecy. They had perceived his situation as an immediate physical threat to their grandchildren, making my educational financing seem less urgent by comparison. However, this understanding did not diminish my anger about their failure to explore alternative solutions or include me in discussions about how to address the crisis. They could have refinanced their house, liquidated investments, or pursued other options that would not have destroyed my financial foundation. What I do not understand, I told Daniel, is why our parents chose to sacrifice my future rather than allowing you to face the consequences of your own choices. Bankruptcy might have been devastating for you personally, but it would not have required destroying someone else's inheritance. Daniel's response revealed the depth of our parents' commitment to protecting him from the results of his gambling addiction. They had apparently researched bankruptcy options but concluded that the timeline for debt discharge would not provide immediate relief from creditor pressure. The trust fund represented the fastest available source of funds large enough to resolve the crisis completely. Alexandra, I know you are angry, and you have every right to be, Daniel said. But I want you to know that I am committed to paying back every dollar that was taken from your trust fund. I am in treatment now, and when I complete the program, I will find a way to make this right. His promise felt hollow, given his track record of failed business ventures and financial irresponsibility, but I appreciated his acknowledgement of the damage that had been done. More importantly, his call provided clarity about the family dynamics that had created this situation and reinforced my determination to build a future that did not depend on their decisions or promises. The fourth major complication arose when I began calculating the true financial requirements for achieving independence from my family's support. Graduate school expenses represented only one component of a larger challenge that included establishing my own housing, transportation, insurance, and emergency reserves. The detailed analysis revealed that I would need to generate significantly more income than any traditional employment could provide within the time frame I had established. Even the highest-paying entry-level positions in finance would require several years to accumulate the savings necessary for complete financial independence. This realization forced me to confront the possibility that my goal of avoiding student loans might be unrealistic given the constraints of conventional career paths. However, rather than accepting this limitation, I began exploring unconventional approaches that could generate higher returns on my time and capabilities. The research I had conducted about community banking and fintech applications suggested potential opportunities for consulting work that could command higher hourly rates than traditional employment. Small banks were increasingly seeking external expertise to navigate technological transformations they could not manage internally. I developed a preliminary business plan for offering technology consulting services specifically to community banks and credit unions. This approach would leverage my academic background in economics and business while building practical experience in the financial services sector that would strengthen my eventual application to Wharton. The consulting concept faced significant challenges, primarily my lack of practical experience in banking operations and technology implementation. However, my research had revealed that many community banks were struggling with similar challenges and were willing to work with external consultants who could provide fresh perspectives and technical expertise. During this research phase, I encountered Professor Margaret Hoffman from Yale's economics department, who had maintained relationships with several community bank executives through her research on regional financial institutions. When I explained my situation and consulting concept, she offered to provide introductions that could help validate my approach. Alexandra, Professor Hoffman said during our meeting in her office, your academic work on financial markets and technological disruption demonstrates sophisticated understanding of the challenges facing community banks. While you lack practical experience, your analytical capabilities and fresh perspective could provide genuine value to institutions that have been unable to address these issues internally. Her endorsement provided the confidence I needed to begin developing my consulting services into a concrete business plan. More importantly, Her offer to facilitate introductions would give me access to potential clients who might otherwise be skeptical of working with a recent graduate. The fifth major complication emerged when I realized that pursuing consulting work would require immediate investment in technology, transportation, and professional development that I could not afford with my current resources. The $50,000 remaining from my trust fund would need to be preserved for graduate school expenses, leaving me without capital for launching a consulting practice. This constraint led me to explore creative financing options that would not require family support or traditional loans. I investigated equipment leasing, revenue-sharing partnerships, and other arrangements that could provide necessary resources, without upfront capital requirements. The solution came from an unexpected source when I learned about a state-funded program designed to support recent graduates who were launching technology-related businesses. The program offered loans with favorable terms, specifically for graduates from accredited universities who could demonstrate viable business plans in high-growth sectors. The application process required detailed financial projections, market analysis, and evidence of potential client interest. These requirements aligned perfectly with the business plan I was already developing for my consulting services, creating an opportunity to secure funding while validating the commercial viability of my approach. As I worked through the loan application, I realized that my parents' betrayal had inadvertently provided me with motivation and focus that I might never have developed under normal circumstances. The necessity of building financial independence from nothing was forcing me to think creatively about value creation and business development in ways that my privileged background had never required. The emotional implications of these cascading consequences proved as challenging as the practical obstacles. I found myself questioning assumptions about family loyalty, financial security, and personal relationships that had shaped my worldview since childhood. The people I had trusted most completely had proven capable of devastating betrayal when their interests conflicted with mine. Sleep became elusive as I processed not only the immediate challenges of building a career and financing, graduate school, but also the deeper questions about trust and independence that my situation had raised. I often lay awake calculating financial projections and business strategies, but equally often found myself wondering whether any relationship could be trusted if my own parents had proven unreliable. The isolation was perhaps the most difficult aspect of navigating these complications. My Yale classmates were celebrating their upcoming graduations and starting positions at prestigious firms, while I was struggling with problems that none of them could understand or relate to. The gap between their carefree transitions and my desperate circumstances made social interactions increasingly uncomfortable. I found myself avoiding conversations about post-graduation plans and future aspirations, partly because my situation was too complex to explain briefly, and partly because the contrast with my peers' experiences was too painful to highlight repeatedly. This social withdrawal compounded the emotional burden of dealing with family betrayal and financial uncertainty. However, as the weeks passed and I made progress on developing concrete solutions to my challenges, I began to recognize unexpected benefits within the crisis my parents had created. The necessity of building something from nothing was developing capabilities and perspectives that privileged circumstances would never have provided. My research into community banking and fintech applications was teaching me about industry dynamics and market opportunities that would prove invaluable throughout my career. The business plan I was developing for my consulting services was forcing me to think strategically about value creation and client relationships in ways that academic study alone could never achieve. Most importantly, the complete elimination of my financial safety net was creating motivation and determination that I had never experienced before. Every decision had significant consequences, every opportunity had to be evaluated carefully, and every resource had to be maximized for optimal impact. By the end of my first month of dealing with these cascading consequences, I had transformed from a shocked and betrayed daughter into someone with a clear understanding of the challenges ahead and a concrete plan for overcoming them. The trust fund was gone, But I had developed capabilities and motivation that would prove more valuable than inherited money. The foundation for my future success was being built through necessity rather than privilege, through strategic thinking rather than emotional reaction, and through personal determination rather than family support. My parents had intended to protect Daniel from the consequences of his poor choices, but they had inadvertently launched me on a journey that would demonstrate the true power of facing challenges rather than avoiding them. The battle for my financial independence and professional success was intensifying, but I was no longer fighting defensively. I was building something that would make their betrayal irrelevant and their judgment about priorities demonstrably wrong. The transition from academic theory to practical business development proved far more challenging than my economics coursework had prepared me to anticipate. During the summer months following my Yale graduation, I discovered that bridging the gap between conceptual understanding of financial markets and actual implementation of business solutions required capabilities that no classroom experience could provide. This period would test every aspect of my analytical abilities while forcing me to develop new skills in relationship building, technical implementation, and strategic positioning that would become the foundation of my eventual success. The first significant challenge emerged when I began reaching out to community banks through the introductions Professor Hoffman had arranged. My initial conversations with bank executives revealed that while they acknowledged the need for technological modernization, their understanding of available solutions and implementation processes was often more limited than my research had suggested. Many of these leaders had built successful careers through traditional relationship banking and personal service, but found themselves struggling to compete against both large national institutions and emerging fintech companies that offered customers superior digital experiences. Robert Martinez, president of Connecticut Valley Community Bank, provided particularly valuable insights during our initial meeting at his institution's headquarters in Hartford. The bank served a customer base of small businesses and individual depositors who valued personal relationships and local decision-making, but increasingly expected digital services comparable to those offered by major national competitors. Ms. Sterling, Martinez explained as we reviewed his institution's current technology infrastructure, our customers remain loyal to us because we know their businesses personally and can make lending decisions based on local market knowledge rather than automated algorithms. However, our online banking platform looks like it was designed 15 years ago. Our mobile app crashes regularly, and our loan application process requires customers to visit our offices multiple times for transactions that our competitors can complete entirely online. The disconnect between the bank's core strengths and its technological capabilities represented exactly the type of opportunity my consulting concept was designed to address. However, as Martinez described the specific challenges his institution faced, I realized that my academic knowledge of financial technology would need to be supplemented by practical understanding of banking operations, regulatory requirements, and vendor management that I had not yet acquired. What we need, Martinez continued, is someone who understands both the technological possibilities and the operational realities of community banking. We have worked with several technology consultants who proposed solutions that sounded impressive, but proved impossible to implement within our regulatory framework or budget constraints. This feedback highlighted a critical gap in my preparation that threatened to undermine my consulting strategy before it could begin generating results. I needed to develop practical expertise in banking operations and technology implementation that would complement my theoretical knowledge of financial markets and business strategy. The solution came through an unexpected opportunity when Martinez mentioned that Connecticut Valley Community Bank was preparing to search for a new chief technology officer who could lead their digital transformation initiative. While the position required more experience than I possessed, Martinez suggested that I might serve as a special projects consultant while they conducted their search, providing me with practical learning opportunities while offering the bank access to fresh perspectives on their technological challenges. This arrangement would allow you to gain hands-on experience with our systems and operations, while helping us evaluate potential solutions and vendors, Martinez proposed. We could structure the engagement as a 3-month project focused on developing a comprehensive technology modernization plan that could guide our permanent CTO hire. The consulting arrangement represented a significant breakthrough in my efforts to build practical expertise while generating income toward my graduate school funding. More importantly, the project would provide access to the detailed operational knowledge I needed to develop effective solutions for other community banking clients. I accepted Martinez's proposal immediately and spent the following week developing a detailed project plan that would maximize my learning while delivering genuine value to Connecticut Valley Community Bank. The scope included comprehensive assessment of their current technology infrastructure, analysis of customer experience pain points, evaluation of available vendor solutions, and development of a phased implementation strategy that would address their most critical needs within realistic budget constraints. The research phase of the project revealed the complexity of challenges facing community banks in their efforts to modernize while maintaining their distinctive advantages. Regulatory requirements for financial institutions created implementation hurdles that did not affect other industries, while budget constraints limited their ability to purchase enterprise-level solutions designed for larger institutions. However, the research also uncovered emerging vendor solutions specifically designed for community banks that offered sophisticated capabilities at price points accessible to smaller institutions. These specialized platforms provided opportunities for community banks to leapfrog their traditional technology limitations while maintaining the personal service and local focus that differentiated them from national competitors. The customer experience analysis proved particularly revealing as I conducted surveys and focus groups with Connecticut Valley Community Bank's depositors and borrowers. The feedback confirmed that customers valued the institution's personal relationships and local decision-making, but were increasingly frustrated by technological limitations that made routine transactions unnecessarily complex and time-consuming. "I love dealing with people who know my business and understand our local market," explained Patricia Wong, who operated a small manufacturing company that had banked with Connecticut Valley Community Bank for over 20 years. "But when I need to check account balances or transfer funds outside normal business hours, their online system is so slow and unreliable that I sometimes use my personal account at a larger bank just to handle urgent transactions." This type of feedback demonstrated that community banks risked losing customers not because of inferior personal service, but because technological limitations prevented customers from accessing that superior service efficiently. The challenge involved enhancing digital capabilities without undermining the relationship focus that represented these institutions' primary competitive advantage. The vendor evaluation process provided intensive education in the practical aspects of banking, technology implementation. I learned about core banking systems, payment processing networks, regulatory reporting requirements, and security protocols that shaped every decision about technological upgrades. This knowledge proved essential for understanding why seemingly simple improvements often required complex integration projects that could take months to complete properly. During this research phase, I encountered David Kim, Chief Technology Officer at Northeastern Regional Bank, a larger community institution that had successfully completed a comprehensive technology modernization project 2 years earlier. Kim's insights about implementation challenges and vendor management proved invaluable for understanding how to navigate the complex process of banking technology upgrades. "The key lesson we learned," Kim explained during our phone conversation, "is that technology implementation in community banking is fundamentally different from other industries because of regulatory requirements and integration complexity. Vendors who understand these constraints can deliver excellent results, while those who treat banks like any other business client typically create expensive disasters." Kim's experience highlighted the importance of vendor selection and project management expertise that extended beyond technical capabilities to include regulatory compliance and operational risk management. This knowledge became central to the recommendations I developed for Connecticut Valley Community Bank and would prove essential for future consulting projects. The financial analysis component of my project revealed additional challenges that community banks faced in justifying technology investments. Unlike larger institutions that could spread implementation costs across millions of customers, community banks needed to achieve positive returns on investment within smaller customer bases while maintaining competitive pricing for their services. However, the analysis also demonstrated that well-designed technology improvements could generate significant operational efficiencies and customer satisfaction improvements that justified their costs within reasonable timeframes. The key involved selecting solutions that addressed the most critical customer needs, while providing measurable benefits that could support continued investment in additional improvements. As I developed implementation recommendations for Connecticut Valley Community Bank, I began to understand how my consulting services could create genuine value for community banking clients. My academic background in economics and business strategy provided analytical capabilities that most technology vendors lacked, while my research into banking operations was developing practical knowledge that distinguished my recommendations from theoretical proposals. The comprehensive technology modernization plan I delivered to Martinez and his executive team represented 3 months of intensive research and analysis that demonstrated both the potential of my consulting approach and the practical knowledge I had acquired through hands-on project work. The plan included detailed vendor recommendations, implementation timelines, budget projections, and risk management strategies that addressed the specific operational and regulatory requirements of community banking. Martinez's response to the deliverable exceeded my expectations and provided validation that my consulting strategy could generate both income and professional development opportunities that would support my graduate school financing goals. Ms. Sterling, Martinez said during our final project meeting, "This analysis is exactly what we needed to move forward with confidence on our technology modernization initiative. Your recommendations are practical, well-researched, and clearly demonstrate understanding of both our operational requirements and our budget constraints. I would like to discuss engaging your consulting services for the implementation phase of this project." The implementation consulting opportunity represented a significant expansion of both my income potential and my practical experience in banking technology projects. However, the timing created potential conflicts with my planned return to Wharton the following year, requiring careful consideration of how to balance short-term income generation with long-term educational objectives. The solution involved structuring the implementation consulting as a part-time engagement that could continue during my first semester at business school, providing ongoing income while complementing my academic coursework with practical application of business concepts. This arrangement would allow me to maintain my relationship with Connecticut Valley Community Bank while pursuing my MBA, creating opportunities for continued collaboration after graduation. During the negotiation process for the implementation consulting contract, I encountered the first significant validation of my financial projections for achieving independence from family support. The combined income from the initial assessment project and the proposed implementation consulting would generate substantially more revenue than traditional employment while providing practical experience that would enhance my business school applications and career prospects. More importantly, the success of my work with Connecticut Valley Community Bank was beginning to generate referrals to other community banks facing similar technological challenges. Martinez had discussed my project with colleagues in the Connecticut Community Banking Association, leading to inquiries from several other institutions interested in similar consulting services. The referral opportunities represented the beginning of a sustainable consulting practice that could support my financial independence while building expertise in an industry sector where my grandfather's legacy provided both credibility and personal motivation. The community banking focus also aligned with my growing interest in financial institutions that served local markets and supported small business development rather than pursuing purely profit-maximizing strategies. As autumn approached and my planned return to Wharton drew closer, I realized that my forced gap year had developed capabilities and market opportunities that exceeded the original scope of my financial necessity planning. The consulting practice was generating sufficient income to cover graduate school expenses while building professional relationships and industry expertise that would prove valuable throughout my career. However, the most significant development during this period involved my growing understanding of community banking challenges and opportunities that would eventually lead to much larger ambitions than consulting services. My research had revealed that many community banks faced existential threats from technological disruption and competitive pressure that could not be addressed through consulting alone. The consolidation trends in community banking suggested opportunities for acquisition and restructuring that could create value while preserving the local service focus that distinguished these institutions from national competitors. My grandfather's experience in building and eventually selling Sterling Community Bank provided a template for how strategic vision and operational excellence could create substantial value in this sector. These insights began forming the foundation of a longer-term strategy that extended beyond graduate school and traditional career paths toward entrepreneurial opportunities in community banking acquisition and development. My consulting work was providing the industry knowledge and relationships that would be essential for pursuing such ambitious objectives. The emotional and psychological impact of this professional development proved as significant as the financial benefits. The success of my consulting practice was demonstrating that my parents' betrayal had inadvertently provided me with motivation and focus that privileged circumstances might never have generated. The necessity of building financial independence from nothing was developing capabilities and confidence that would serve me throughout my career. More importantly, the progress I was making toward my goals was proving that their decision to prioritize Daniel's immediate crisis over my long-term future had been strategically wrong as well as morally questionable. My ability to create value and generate income through my own efforts was validating my grandfather's belief in the power of individual determination and strategic thinking. The contrast between my proactive response to crisis and Daniel's passive acceptance of family rescue was becoming increasingly apparent as I received periodic updates about his situation. While I was building a consulting practice and developing industry expertise, he remained in treatment with no clear plan for generating the income necessary to repay the trust fund money that had been used to cover his gambling debts. The irony was not lost on me that my parents' choice to sacrifice my financial foundation in order to protect Daniel from consequences was enabling his continued dependence while forcing me to develop the independence and capabilities that would ultimately make their support irrelevant. Their misguided attempt to help him was actually helping me in ways they could not understand or anticipate. As I prepared to submit my final application materials to Wharton and transition from full-time consulting to graduate school, I reflected on the transformation that had occurred during my forced gap year. I had entered this period as a betrayed daughter whose future had been destroyed by family dysfunction, but I was concluding it as someone with practical business experience, industry expertise, and financial independence that exceeded my original expectations. The foundation I had built through necessity rather than privilege would support not only my immediate graduate school objectives, but also longer-term ambitions that were beginning to crystallize around opportunities in community banking acquisition and development. My parents had intended to protect Daniel from failure, but they had inadvertently launched me toward success that would dwarf anything I might have achieved through conventional paths supported by inherited advantages. The trust fund they had given away represented money that would have been spent on education and consumed within 2 years. The capabilities and relationships I had developed through being forced to replace that money would generate value throughout my career, while positioning me for opportunities that inherited wealth could never provide. Their betrayal was becoming the foundation of my independence, and their poor judgment was becoming the catalyst for achievements that would validate my grandfather's belief in the power of strategic thinking and determined effort. The moment that would fundamentally transform my perspective from tactical problem-solving to strategic empire-building occurred during an unremarkable Tuesday morning in November, while I was reviewing quarterly financial reports in the offices of Connecticut Valley Community Bank. I had been working as their technology implementation consultant for 3 months while completing my first semester at Wharton through a carefully orchestrated schedule that allowed me to maintain both commitments simultaneously. The revelation came not through dramatic circumstances, but through a seemingly routine conversation with Robert Martinez about his institution's acquisition discussions with a struggling competitor. As he explained the financial mechanics and strategic rationale behind the potential merger, I experienced a profound shift in understanding that would reshape every aspect of my professional ambitions and personal mission. Martinez had invited me to review the confidential due diligence materials for Valley Regional Bank, a smaller community institution that was exploring strategic alternatives after experiencing significant losses from commercial real estate investments. The failing bank situation was not uncommon in the post-financial crisis environment, where many smaller institutions faced capital adequacy problems that threatened their independent existence. Ms. Sterling, Martinez explained as he spread the financial statements across the conference table, Valley Regional represents exactly the type of opportunity that could accelerate our growth strategy if we can structure the acquisition properly. Their customer base aligns well with our market focus. Their branch locations would expand our geographic coverage, and their distressed pricing could provide substantial value creation potential. As I examined the detailed financial analysis, something profound began crystallizing in my understanding of community banking dynamics and wealth creation opportunities. The numbers revealed not just a potential acquisition target, but a systematic pattern of value creation that existed throughout the fragmented community banking sector. Valley Regional Bank's core problem was not fundamental business model failure, but rather inadequate capital reserves and poor risk management decisions that had created temporary liquidity constraints. The institution served a loyal customer base, operated in attractive markets, and possessed valuable assets that were being undervalued due to their current financial distress. More significantly, the acquisition pricing being discussed would allow Connecticut Valley Community Bank to purchase assets worth substantially more than the negotiated purchase price, creating immediate value for the acquiring institution while preserving employment and customer relationships that would otherwise be lost through closure or forced sale to a larger competitor. The strategic implications of this transaction extended far beyond the immediate benefits to Connecticut Valley Community Bank. I began to recognize that the community banking sector contained numerous similar opportunities where patient capital and strategic expertise could create substantial value while serving the broader economic purpose of preserving local financial institutions. My grandfather's experience with Sterling Community Bank suddenly became relevant in ways I had not previously understood. His success had not been built solely through organic growth and operational excellence, but also through strategic acquisitions of smaller institutions that he had integrated into a more efficient and profitable regional network. The historical research I conducted that evening revealed that Sterling Community Bank had completed over a dozen acquisitions during its growth phase, transforming from a single-location institution into a regional powerhouse through systematic identification and integration of acquisition targets. My grandfather had essentially created a template for community banking consolidation that generated substantial value for shareholders while preserving the local service focus that distinguished these institutions from national competitors. This discovery prompted a fundamental reconsideration of my career trajectory and professional objectives. While my consulting practice was generating sufficient income to support my graduate school expenses and building valuable industry relationships, the acquisition opportunities in community banking represented potential for wealth creation that exceeded anything I could achieve through traditional career paths. The emotional significance of this realization was equally profound. My parents had destroyed my trust fund to protect Daniel from the consequences of his gambling addiction, but they had inadvertently positioned me to understand and pursue opportunities for wealth creation that would ultimately dwarf the inheritance they had given away. The irony was staggering. Their betrayal had forced me to develop expertise in exactly the sector where my grandfather had created substantial wealth, while my forced independence had provided the motivation and analytical capabilities necessary to recognize opportunities that privileged circumstances might have obscured. During the following week, I expanded my research to examine community banking acquisition trends throughout New England and the broader Northeast region. The analysis revealed systematic patterns of consolidation that created opportunities for strategic acquirers who understood both the operational challenges and the value creation potential within this sector. The regulatory environment favored consolidation among community banks as federal oversight agencies preferred to facilitate mergers rather than manage institutional failures that could disrupt local markets and require deposit insurance payouts. This regulatory support created opportunities for well-capitalized acquirers to purchase distressed institutions at attractive prices while receiving regulatory assistance with the integration process. More importantly, the demographic and economic trends affecting many rural and suburban markets created challenges for standalone community banks that could be addressed more effectively through consolidation with institutions that possessed greater resources and technical capabilities. My consulting work had provided detailed insights into the operational inefficiencies and technological limitations that constrained many community banks' profitability and growth prospects. These challenges were expensive for individual institutions to address independently, but could be resolved efficiently through consolidation strategies that spread implementation costs across larger customer bases. The financial analysis revealed that successful community banking consolidation could generate returns substantially exceeding those available through traditional investment approaches, while also creating meaningful economic and social value through preservation of local financial services that might otherwise be lost to market consolidation. This research culminated in a comprehensive business plan for a community banking acquisition strategy that would leverage my industry expertise, professional relationships, and educational credentials to identify and execute value-creating transactions throughout the Northeast region. The plan addressed three critical components: capital-raising strategies that could provide funding for acquisitions without diluting control, due diligence processes that could identify the most attractive targets while avoiding institutions with hidden problems, and integration methodologies that could realize projected synergies while maintaining customer relationships and regulatory compliance. The capital requirements represented the most significant challenge for implementing this strategy. Community bank acquisitions typically required substantial upfront investment that would necessitate either institutional funding or partnership arrangements with experienced investors who understood the sector's unique characteristics and regulatory requirements. However, my research had identified several private equity firms and family investment offices that specialized in community banking investments and had established track records of successful value creation through strategic consolidation. These potential partners possessed the financial resources necessary for acquisitions while lacking the operational expertise and industry relationships that my background could provide. The partnership concept began forming the foundation of a long-term strategy that could leverage my developing expertise while accessing the capital necessary for meaningful acquisition activity. This approach would allow me to participate in wealth creation opportunities that individual resources could never support, while building experience and relationships that could support eventual independent activity. As I refined this strategic vision throughout the remainder of my first semester at Wharton, I began to understand how my academic coursework could be optimized to support these professional objectives. The business school's curriculum in corporate finance, merger and acquisition strategy, and private equity methods provided exactly the analytical frameworks necessary for sophisticated community banking investments. More importantly, Wharton's extensive alumni network included numerous professionals in private equity, investment banking, and commercial lending who possessed both the expertise and the resources necessary for executing community banking acquisition strategies. My unique combination of industry knowledge and academic credentials positioned me to develop relationships with potential partners and investors who could support ambitious acquisition objectives. The networking opportunities available through business school became particularly valuable when I encountered Margaret Chen, a second-year MBA student whose family had built substantial wealth through real estate investments and was exploring diversification into financial services. Margaret's background in investment analysis and her family's capital resources created potential for exactly the type of partnership that could accelerate my community banking acquisition strategy. During our initial conversation about potential collaboration, Margaret expressed genuine interest in the community banking sector as an investment opportunity that could provide steady returns while supporting economic development in underserved markets. Alexandra, Margaret said during our meeting at the business school library, your analysis of community banking consolidation opportunities aligns perfectly with our family's investment philosophy. We prefer sectors where operational expertise can create competitive advantages and where patient capital can generate superior returns through strategic, rather than purely financial approaches. Margaret's enthusiasm for the community banking investment concept provided validation that my strategic vision had commercial potential beyond personal ambition. Her family's investment capacity, combined with my industry expertise and professional relationships, could support acquisition activity at a scale that would create meaningful market presence while generating substantial wealth through systematic value creation. The partnership discussions with Margaret also clarified the timeline and milestones necessary for implementing my community banking acquisition strategy. While immediate activity would require completion of my MBA program and additional industry experience, the foundation could be established during business school through continued consulting work, relationship development, and preliminary due diligence on potential acquisition targets. This extended timeline actually provided advantages for strategy development and market positioning. The community banking sector was experiencing ongoing consolidation pressure that would likely create additional acquisition opportunities over the next several years, while my continued education and experience would enhance my credibility with potential sellers and regulatory authorities. During this strategic planning process, I received an unexpected phone call from Daniel that provided additional motivation for pursuing ambitious wealth creation objectives. He was calling from California, where he had completed his gambling addiction treatment program and was preparing to return to Connecticut to rebuild his life and begin repaying the trust fund money that had been used to cover his debts. Alexandra, he said, his voice carrying a mixture of shame and determination that I had not heard previously, I wanted to let you know that I am committed to making things right with you. I have found a job with a construction company, and I plan to send you monthly payments until I have repaid every dollar that was taken from your inheritance. Daniel's promise to repay the trust fund money was well-intentioned, but financially unrealistic, given his employment prospects and family obligations. The construction job he had secured would provide modest income that would be consumed primarily by basic living expenses and child support obligations. Even under optimistic assumptions about his earning potential, full repayment would require decades rather than years. However, his call served as a powerful reminder of the original injustice that had launched my journey toward financial independence and professional success. My parents had sacrificed my inheritance to protect Daniel from consequences, but my response to that betrayal was creating opportunities for wealth generation that would ultimately make their decision irrelevant while demonstrating the folly of enabling irresponsible behavior rather than demanding accountability. The contrast between Daniel's modest repayment plan and my ambitious acquisition strategy highlighted the difference between reactive problem-solving and proactive value creation. While he was focused on addressing past mistakes through incremental effort, I was building capabilities and relationships that would create substantial wealth through strategic thinking and systematic execution. This realization prompted deeper reflection about the psychological and emotional aspects of my transformation from betrayed daughter to ambitious entrepreneur. The trust fund betrayal had initially felt like a devastating setback that threatened to derail my carefully planned future, but it had actually provided motivation and focus that privileged circumstances might never have generated. The necessity of building financial independence from nothing had forced me to develop capabilities and perspectives that would prove more valuable than inherited money throughout my career. My consulting practice had provided practical business experience and industry relationships that complemented my academic education, while my acquisition strategy represented application of strategic thinking skills that had been honed through navigating crisis and uncertainty. More significantly, the betrayal had eliminated any psychological dependence on family support or approval that might have constrained my ambitions or limited my willingness to pursue unconventional opportunities. I was building wealth and developing expertise entirely through my own efforts, which provided confidence and independence that trust fund security could never have delivered. As the first semester of business school concluded, and I prepared to intensify my community banking research during winter break, I reflected on the remarkable transformation that had occurred since my parents' devastating revelation in our family. Breakfast room 18 months earlier. The frightened and angry daughter who had discovered the loss of her inheritance had evolved into someone with industry expertise, professional relationships, and strategic vision that positioned her for wealth creation opportunities that exceeded the original trust fund value by orders of magnitude. My parents had intended to protect Daniel from failure, but they had inadvertently launched me toward success that would demonstrate the power of facing challenges rather than avoiding them, of building capabilities rather than expecting support, and of creating value rather than merely consuming inherited advantages. The community banking acquisition strategy I was developing represented more than a business plan. It embodied my grandfather's belief in the power of strategic thinking and determined effort, while providing a vehicle for demonstrating that my parents' judgment about priorities and values had been catastrophically wrong. They had chosen to enable weakness rather than empower strength, to reward failure rather than support success, and to sacrifice long-term potential for short-term crisis management. The wealth I would create through community banking acquisitions would serve as permanent proof that their decision represented not just moral failure but strategic incompetence. The foundation was established, the vision was clear, and the execution phase could begin. My parents had given away my trust fund, but they had inadvertently provided me with something far more valuable: the motivation and opportunity to build an empire that would make their betrayal irrelevant and their priorities demonstrably inferior to the principles my grandfather had embodied throughout his career. The winter months between my first and second semesters at Wharton proved to be a period of intensive strategic development that would establish the detailed foundation for my community banking acquisition strategy. Having recognized the transformative potential within the sector, I dedicated myself to conducting comprehensive market analysis, developing sophisticated financial models, and building the professional relationships necessary to execute transactions at meaningful scale. The research process began with systematic analysis of community banking performance metrics across the Northeast region, focusing specifically on institutions with assets between $50 million and $500 million. This size range represented the optimal target profile for initial acquisition activity, offering sufficient scale to generate meaningful returns while remaining small enough to avoid the regulatory complexity associated with larger transactions. The data revealed compelling patterns that validated my strategic thesis. Community banks within this asset range consistently struggled with operational efficiency challenges that could be addressed through strategic consolidation, while many possessed valuable franchise characteristics that were being undervalued by current market conditions. The combination of operational inefficiencies and franchise value created opportunities for acquirers who could implement best practices while preserving customer relationships and local market presence. My analysis identified specific financial metrics that distinguished potentially successful acquisition targets from institutions facing fundamental business model problems. The most attractive candidates typically exhibited strong deposit growth and customer loyalty, despite earnings pressure from operational inefficiencies or credit quality issues that could be addressed through improved management and systems integration. Conversely, Institutions experiencing customer attrition or significant market share losses to larger competitors represented higher risk investments that could prove difficult to turn around, regardless of acquisition pricing or post-transaction improvements. This distinction became central to the screening methodology I developed for identifying optimal acquisition targets. The regulatory environment analysis revealed that federal and state banking authorities actively encouraged community bank consolidation as a means of preserving local financial services while improving institutional stability and compliance capabilities. This regulatory support created opportunities for acquiring institutions to receive expedited approval processes and technical assistance with integration planning. Furthermore, the regulatory framework provided multiple acquisition structures that could optimize tax efficiency and capital requirements depending on the specific circumstances of target institutions and acquirer objectives. These structural alternatives offered flexibility for negotiating transactions that addressed seller concerns while maximizing value creation potential for acquiring entities. The competitive landscape research demonstrated that traditional acquirers of community banks typically fell into three categories: larger regional banks seeking geographic expansion, private equity firms pursuing financial returns through operational improvements, and established community banking groups implementing systematic consolidation strategies. However, my analysis revealed gaps in the market where new entrants with specialized expertise and patient capital could compete effectively against these traditional acquirers. Many sellers preferred working with buyers who understood community banking culture and were committed to preserving local service capabilities rather than pursuing purely cost reduction strategies. This market positioning opportunity became fundamental to my strategic approach. By emphasizing operational enhancement rather than wholesale cost reduction, and by demonstrating commitment to preserving community banking values while improving efficiency and profitability, I could differentiate my acquisition strategy from approaches that focused primarily on financial engineering or geographic consolidation. The capital requirements analysis represented the most complex component of my strategic planning process. Community bank acquisitions typically required equity investments ranging from $10 million to $50 million, depending on target institution size and financial condition. Additionally, successful integration often necessitated additional capital injections to support technology upgrades, system conversions, and working capital requirements during transition periods. These capital requirements exceeded individual investor capacity and necessitated institutional funding sources or sophisticated partnership arrangements with experienced investors. My research identified several potential funding approaches that could provide necessary resources while preserving operational control and strategic flexibility. Private equity partnerships offered the most straightforward approach to accessing acquisition capital, but typically required giving up significant ownership stakes and accepting return expectations that might conflict with long-term value creation strategies. However, some private equity firms specialized in community banking investments and had demonstrated willingness to accept longer investment horizons in exchange for operational expertise and industry relationships. Family office partnerships represented an alternative approach that could provide patient capital with more flexible return expectations and greater alignment with strategic rather than purely financial objectives. Many family offices were seeking diversification opportunities in sectors where operational expertise could create competitive advantages and where investment horizons could extend beyond traditional private equity timeframes. Debt financing could supplement equity investments and improve overall returns through appropriate leverage. But community bank acquisitions required specialized lenders who understood the regulatory requirements and operational characteristics of financial institutions. Commercial banks that focused on the community banking sector offered acquisition financing products specifically designed for these transactions. My partnership discussions with Margaret Chen evolved significantly during this strategic planning period as we developed detailed frameworks for potential collaboration. Margaret's family investment office possessed the financial capacity and investment philosophy necessary for community banking acquisitions, while my industry expertise and professional relationships provided operational capabilities that could enhance investment performance. The partnership structure we developed addressed capital contributions, decision-making authority, and profit distribution in ways that aligned our respective strengths while providing appropriate incentives for successful execution. Margaret's family would provide primary acquisition capital and leverage their broader investment experience, while I would contribute industry expertise and assume operational responsibility for target identification, due diligence, and post-acquisition integration. This collaborative approach offered advantages that neither party could achieve independently. Margaret's family gained access to specialized investment opportunities with attractive risk-adjusted returns, while I obtained the capital resources necessary for meaningful acquisition activity without diluting control over strategic decisions or operational management. The due diligence methodology I developed represented synthesis of traditional financial analysis with specialized banking, sector considerations that reflected regulatory requirements and operational complexities unique to financial institutions. The framework addressed asset quality assessment, regulatory compliance evaluation, technology infrastructure analysis, and customer relationship stability measurement. Asset quality represented the most critical component of banking sector due diligence, as loan portfolio problems could create ongoing losses that would undermine acquisition economics regardless of operational improvements. My methodology emphasized detailed review of lending practices, credit administration procedures, and loan documentation standards to identify institutions with sound underwriting cultures versus those with systemic credit quality problems. Regulatory compliance assessment required understanding of examination ratings, enforcement actions, and outstanding regulatory commitments that could constrain operational flexibility or require additional capital investments post-acquisition. This analysis determined whether target institutions faced regulatory obstacles that could complicate integration planning or limit strategic alternatives. Technology infrastructure evaluation became increasingly important as community banks faced pressure to modernize digital capabilities while managing implementation costs and operational risks. My methodology assessed current technology platforms, vendor relationships, and upgrade requirements to estimate post-acquisition investment needs and integration complexity. Customer relationship analysis examined deposit stability, loan customer retention rates, and market share trends to evaluate franchise value and competitive positioning. This assessment determined whether target institutions possessed genuine customer loyalty and market presence or were experiencing erosion that could accelerate under new ownership. The integration planning framework I developed addressed the operational challenges of combining community banking operations while preserving customer relationships and regulatory compliance. This methodology emphasized phased implementation approaches that minimized disruption while achieving projected synergies within realistic timeframes. System conversions represented the most complex aspect of community bank integration, requiring coordination between multiple technology vendors while maintaining continuous service availability for customers. My framework provided detailed project management approaches for managing these conversions while minimizing operational risk and customer impact. Cultural integration planning addressed the human resource challenges of combining banking organizations with different management philosophies and operational practices. This component emphasized communication strategies, retention programs, and training initiatives that could preserve institutional knowledge while implementing best practices across combined operations. The financial modeling framework I developed provided sophisticated analysis of acquisition economics under various scenarios and assumptions. These models incorporated revenue enhancement opportunities, expense reduction potential, and capital requirement changes to project returns on investment and optimal acquisition pricing for different target profiles. Revenue enhancement modeling examined opportunities to improve pricing, expand customer relationships, and introduce new products or services that could increase profitability without compromising customer satisfaction or market positioning. This analysis identified realistic growth assumptions that could support acquisition valuations while avoiding overly optimistic projections. Expense reduction analysis focused on operational efficiencies that could be achieved through technology improvements, process standardization, and administrative consolidation without undermining service quality or regulatory compliance. This component provided conservative estimates of cost savings that could be realized within specific timeframes. Capital requirement modeling addressed regulatory capital needs, technology investment requirements, and working capital changes that would affect cash flow projections and return calculations. This analysis ensured that acquisition pricing reflected all incremental investments necessary for successful integration and ongoing operations. The market opportunity assessment I completed during this planning period identified specific geographic markets and institutional targets that offered optimal conditions for implementing my acquisition strategy. This analysis considered market, demographics, competitive dynamics, regulatory environments, and economic trends that could affect community banking performance. The Northeast region offered particularly attractive opportunities due to its fragmented community banking sector, stable economic conditions, and demographic trends that supported continued demand for local financial services. Many markets contained multiple small institutions that could benefit from consolidation while preserving competitive choice and local service capabilities. My target identification process produced a prioritized pipeline of potential acquisition candidates that met my investment criteria and appeared likely to consider strategic alternatives within reasonable timeframes. This pipeline provided specific transaction opportunities that could support near-term acquisition activity while my partnership arrangements and funding sources were being finalized. The relationship development strategy I implemented during this period focused on building credibility and trust with key stakeholders in the community banking sector, who could provide transaction opportunities, regulatory guidance, and operational support for acquisition activity. These relationships would prove essential for accessing deal flow and executing transactions successfully. Banking regulatory attorneys provided expertise in transaction structuring, approval processes, and compliance requirements that would be necessary for navigating the complex legal framework governing bank acquisitions. These professional relationships offered access to specialized knowledge that could differentiate my acquisition approach from less experienced competitors. Community banking executives offered insights into operational challenges, market dynamics, and strategic considerations that informed my due diligence methodology and integration planning approaches. These relationships provided access to industry knowledge that enhanced my credibility with potential sellers and regulatory authorities. Investment banking professionals who specialized in community bank transactions provided access to deal flow, valuation benchmarks, and transaction execution expertise that could accelerate my acquisition timeline, while ensuring appropriate pricing and structure for specific opportunities. As my second semester at Wharton commenced, I had established comprehensive strategic foundation for community banking acquisitions that addressed capital requirements, partnership structures, due diligence methodologies, integration planning frameworks, and market opportunity assessment. The detailed planning process had transformed my initial vision into actionable strategy with specific implementation steps and measurable objectives. The foundation I had built through necessity rather than privilege was now supporting ambitious wealth creation objectives that could validate my grandfather's principles while demonstrating the strategic superiority of facing challenges rather than avoiding them. My parents had sacrificed my inheritance to protect Daniel from consequences, but they had inadvertently launched me toward opportunities that would exceed their imagination and prove their judgment fundamentally flawed. The planning phase was complete, and the execution phase could begin with confidence in both the strategic vision and the operational capabilities necessary for success. The community banking sector offered opportunities for value creation that would establish permanent financial independence while honoring my grandfather's legacy and demonstrating the transformative power of strategic thinking combined with determined effort. The transition from strategic planning to active implementation began during the spring semester of my second year at Wharton, when the comprehensive framework I had developed during the winter months started generating concrete opportunities for community banking acquisitions. The theoretical models and partnership structures that had occupied months of analysis suddenly became practical tools for evaluating real transactions and building the professional relationships necessary for executing my ambitious strategy. The first significant breakthrough occurred when Robert Martinez contacted me about another acquisition opportunity that Connecticut Valley Community Bank was considering. However, this conversation would prove fundamentally different from our previous discussions about Valley Regional Bank, as Martinez was now proposing that I participate directly in the transaction, rather than merely providing consulting analysis. Alexandra, Martinez explained during our meeting at his office in Hartford, our board has been impressed with your strategic analysis and industry knowledge, particularly your insights about integration planning and operational enhancement. We have identified an acquisition target that aligns perfectly with your community banking consolidation thesis, and we would like to explore the possibility of structuring this transaction as a joint venture that could serve as a pilot program for your investment strategy. The target institution was Berkshire County Community Bank, a $75 million asset institution based in western Massachusetts that served rural markets through 4 branch locations. The bank had been family-owned for 3 generations, but was now seeking strategic alternatives due to succession planning challenges and capital adequacy pressures that threatened their independence. The financial analysis revealed exactly the type of opportunity that my research had identified as optimal for value creation through strategic consolidation. Berkshire County Community Bank possessed strong customer relationships and market presence in their local communities, but struggled with operational inefficiencies and technology limitations that constrained profitability and growth potential. Martinez proposed a transaction structure where Connecticut Valley Community Bank would serve as the acquiring entity, while my partnership with Margaret Chen would provide supplemental capital and operational expertise for the integration process. This arrangement would allow me to gain practical experience with community bank acquisitions while generating returns for my investment partnership and strengthening my relationship with Connecticut Valley Community Bank. The proposed joint venture represented validation that my strategic analysis and professional development had created genuine credibility within the community banking sector. Martinez was essentially offering me the opportunity to participate in real acquisition activity rather than merely consulting on theoretical scenarios. After reviewing the preliminary due diligence materials and discussing the opportunity with Margaret Chen, I accepted Martinez's proposal to participate in the Berkshire County Community Bank acquisition. This decision marked the beginning of my direct involvement in community banking transactions and provided the practical experience necessary for eventually pursuing independent acquisition activity. The due diligence process for Berkshire County Community Bank proved to be an intensive education in the practical complexities of evaluating financial institutions for acquisition. While my analytical framework provided excellent guidance for organizing the evaluation process, the actual implementation required navigating regulatory requirements, coordinating multiple professional service providers, and managing information flow among various stakeholders with different interests and expertise levels. The asset quality analysis revealed that Berkshire County Community Bank maintained conservative lending practices and had experienced minimal credit losses during the recent economic downturn. Their loan portfolio consisted primarily of commercial real estate financing for local businesses and residential mortgages for community members, with underwriting standards that emphasized personal relationships and local market knowledge rather than automated scoring models. However, the institution's conservative lending approach had also limited their growth potential and contributed to below-average profitability metrics compared to peer institutions. The loan pricing reflected competitive pressure from larger, Banks, while administrative costs remained elevated due to manual processes and outdated technology systems. The operational efficiency analysis identified multiple opportunities for improvement through technology upgrades, process standardization, and administrative consolidation with Connecticut Valley Community Bank. These enhancements could reduce operating expenses while improving customer service capabilities and competitive positioning in their local markets. The regulatory compliance evaluation revealed that Berkshire County Community Bank maintained satisfactory examination ratings and had no outstanding enforcement actions or regulatory concerns that could complicate the acquisition process. Their compliance infrastructure was adequate for their current operations, but would benefit from integration with Connecticut Valley Community Bank's more sophisticated systems and procedures. The technology assessment confirmed that Berkshire County Community Bank operated legacy systems that required significant upgrades to meet contemporary customer expectations and regulatory requirements. However, their current vendor relationships and system architecture would facilitate integration with Connecticut Valley Community Bank's platforms without excessive complexity or customer disruption. The cultural integration analysis proved particularly important given the family ownership history and strong community ties that characterized Berkshire County Community Bank's organizational culture. The due diligence process revealed that employees and customers valued the institution's personal service approach and local decision-making capabilities, factors that would need to be preserved through the acquisition and integration process. The financial modeling for the Berkshire County Community Bank acquisition incorporated revenue enhancement opportunities, expense reduction potential, and integration costs to project returns on investment under various operational scenarios. The analysis demonstrated that appropriate acquisition pricing could generate attractive returns while preserving the institution's community banking characteristics and customer relationships. The negotiation process with Berkshire County Community Bank's ownership family required balancing financial objectives with emotional considerations related to preserving their family legacy and protecting employee relationships. The seller's priorities extended beyond transaction pricing to include assurances about operational continuity and community commitment that would influence their willingness to complete the transaction. Martinez and I developed a negotiation strategy that emphasized Connecticut Valley Community Bank's commitment to preserving local service capabilities while enhancing operational efficiency and growth potential. This approach differentiated our proposal from competing offers that focused primarily on cost reduction and administrative consolidation. The transaction structure that emerged from these negotiations incorporated earn-out provisions tied to customer retention and operational performance metrics that aligned seller interests with post-acquisition success. These provisions provided additional compensation for the selling family while creating incentives for smooth transition and continued community engagement. My participation in the transaction included both financial investment through my partnership with Margaret Chen and operational responsibility for integration planning and implementation. This dual role provided comprehensive exposure to all aspects of community bank acquisitions while establishing my credibility as someone who could contribute both capital and expertise to these transactions. The regulatory approval process required extensive documentation of transaction rationale, integration planning, and compliance capabilities that would govern the combined institution's operations. This process provided detailed education in the regulatory framework that governs community bank acquisitions and the approval criteria that regulatory authorities apply to these transactions. The Federal Deposit Insurance Corporation and state banking regulators required evidence that the acquisition would enhance rather than diminish the financial strength and operational capabilities of the surviving institution. This requirement necessitated detailed projections of capital adequacy, operational efficiency, and compliance capabilities under various economic scenarios. The community benefits analysis required demonstration that the acquisition would preserve or enhance financial services availability in the affected markets, rather than reducing competitive choice or service quality for local customers. This analysis became central to regulatory approval and public comment processes. The integration planning process that began during regulatory review provided practical experience in the operational complexities of combining community banking operations while maintaining regulatory compliance and customer satisfaction. This planning addressed system conversions, employee integration, customer communication, and operational standardization across multiple dimensions. The system conversion planning required coordination among multiple technology vendors and regulatory authorities to ensure continuous service availability during platform migration. This process involved detailed project management approaches for managing technical complexity while minimizing operational risk and customer impact. The employee integration planning addressed staffing optimization, training requirements, and cultural assimilation strategies that could preserve institutional knowledge while implementing best practices across combined operations. This component emphasized communication strategies and retention programs that could maintain continuity during organizational transition. The customer communication strategy focused on preserving relationships and managing expectations throughout the acquisition and integration process. This approach emphasized continuity of service capabilities while highlighting enhancements that would result from increased resources and operational efficiency. The successful completion of the Berkshire County Community Bank acquisition in August marked a significant milestone in my professional development and validated the strategic framework I had developed for community banking investments. The transaction generated positive returns for all stakeholders, while demonstrating that my analytical capabilities and integration methodologies could create genuine value in real-world applications. More importantly, the acquisition experience provided credibility and relationships that would support expanded activity in the community banking sector. The successful integration of Berkshire County Community Bank established my reputation as someone who could execute complex transactions while preserving the community banking values that distinguished these institutions from larger competitors. The financial returns from my participation in the Berkshire County Community Bank acquisition exceeded my initial projections and provided additional capital for pursuing independent acquisition opportunities. The combination of investment returns and consulting income had generated sufficient resources to support more ambitious transaction activity without requiring additional external financing. The professional relationships I had developed through the acquisition process created access to deal flow and industry expertise that would prove essential for identifying and evaluating future opportunities. Banking attorneys, regulatory consultants, and technology vendors who had worked on the Berkshire County Community Bank transaction became valuable resources for subsequent acquisition activity. The operational experience I had gained through managing the integration process provided practical knowledge about community banking operations that complemented my academic education and theoretical analysis. This experience enhanced my credibility with potential sellers and regulatory authorities while improving my ability to evaluate acquisition opportunities accurately. The success of the Berkshire County Community Bank acquisition also strengthened my partnership with Margaret Chen and validated our collaborative approach to community banking investments. Margaret's family investment office was pleased with the transaction returns and expressed interest in supporting additional acquisition activity at larger scale. During the fall semester of my second year at Wharton, I began leveraging the credibility and relationships established through the Berkshire County Community Bank acquisition to identify additional transaction opportunities. The success of the initial acquisition had demonstrated that my strategic framework could generate attractive returns while creating value for all stakeholders involved in these transactions. The pipeline development process revealed multiple potential targets that met my investment criteria and appeared likely to consider strategic alternatives within reasonable timeframes. These opportunities ranged from family-owned institutions facing succession planning challenges to community banks experiencing competitive pressure that could be addressed through strategic consolidation. The due diligence methodology I had refined through the Berkshire County Community Bank experience proved applicable across different target profiles while providing consistent framework for evaluating acquisition opportunities. This systematic approach enhanced efficiency while ensuring comprehensive assessment of risks and opportunities associated with each potential transaction. The integration capabilities I had developed through practical experience provided competitive advantages in negotiating with potential sellers who prioritized operational continuity and cultural preservation over purely financial considerations. Many community bank owners were more concerned about preserving their institutional legacy than maximizing transaction proceeds. As my final year at Wharton approached, I had successfully transitioned from theoretical analysis to practical implementation of community banking acquisition strategy. The combination of academic education, consulting experience, and actual transaction execution had provided comprehensive preparation for pursuing larger and more complex acquisition opportunities after graduation. The foundation I had built through necessity rather than privilege was now supporting acquisition activity that generated both financial returns and professional credibility within the community banking sector. My parents had sacrificed my trust fund to protect Daniel from consequences, but their betrayal had inadvertently launched me toward wealth creation opportunities that would exceed their imagination, while validating my grandfather's principles about strategic thinking and determined effort. The momentum generated through the Berkshire County Community Bank acquisition was accelerating my progress toward the ultimate objective of acquiring sufficient banking assets to influence the financial institutions that served my family's local market. The strategic vision that had emerged from crisis and betrayal was becoming operational reality through systematic execution and strategic relationship building. The successful completion of the Berkshire County Community Bank acquisition created a transformation in how the community banking sector perceived my capabilities and strategic vision. What had begun as theoretical analysis supported by academic credentials had evolved into demonstrated expertise, validated through practical execution and measurable results. The financial returns generated through the transaction, combined with the operational success of the integration process, established my reputation as someone who could deliver value creation while preserving the community banking principles that distinguish these institutions from larger competitors. The credibility established through the Berkshire County transaction began generating opportunities that exceeded the scope of my original strategic planning. Banking executives who had initially viewed me as an academically accomplished consultant now recognized me as a serious participant in community banking consolidation with proven capabilities for identifying attractive acquisition targets and executing complex integration projects. The first major validation of this enhanced reputation came through an invitation to speak at the New England Community Banking Association's annual Strategic Planning Conference. The conference committee had requested that I present a case study analysis of the Berkshire County Community Bank acquisition, focusing specifically on the integration methodologies and operational enhancement strategies that had generated superior returns while maintaining customer satisfaction and regulatory compliance. The speaking opportunity represented significant professional recognition within an industry that typically preferred established relationships and proven track records over innovative approaches or academic credentials. The invitation demonstrated that my transaction success had earned respect from community banking leaders who could provide access to additional acquisition opportunities and strategic partnerships. The presentation I developed for the conference synthesized the practical lessons learned through the Berkshire County acquisition with the broader strategic framework I had developed for community banking consolidation. The analysis demonstrated how systematic due diligence, careful integration planning, and cultural sensitivity could create value while preserving the local service capabilities that represented these institutions' primary competitive advantage. The audience response exceeded my expectations and provided validation that my approach addressed genuine challenges facing community banking executives throughout the region. Multiple attendees approached me after the presentation to discuss potential acquisition opportunities within their own markets, while others sought consulting services for operational enhancement projects that could improve their competitive positioning. The conference also provided opportunities to develop relationships with banking attorneys, regulatory consultants, and technology vendors who specialized in community banking transactions. These professional connections would prove essential for accessing deal flow and executing future acquisitions efficiently while maintaining compliance with regulatory requirements and industry best practices. During the months following the conference, I received inquiries about potential transactions from community bank owners in Connecticut, Massachusetts, Vermont, and New Hampshire. These opportunities ranged from family succession planning situations to competitive pressure scenarios where consolidation could provide operational efficiencies and enhanced market presence. The increased deal flow required systematic evaluation processes that could identify the most attractive opportunities while efficiently screening out transactions that did not meet my investment criteria or operational standards. The due diligence methodology I had developed through the Berkshire County transaction provided excellent framework for this evaluation process, but the volume of opportunities necessitated additional analytical capabilities and professional resources. The solution involved expanding my partnership arrangement with Margaret Chen to include dedicated staff resources for transaction analysis and integration planning. Margaret's family investment office possessed the infrastructure necessary for supporting multiple simultaneous acquisitions while maintaining the analytical rigor required for successful community banking investments. The expanded partnership structure addressed both capital requirements and operational capabilities necessary for pursuing larger and more complex acquisition opportunities. Margaret's family would provide increased financial resources while I would contribute industry expertise and assume responsibility for transaction execution and post-acquisition integration across multiple institutions. This enhanced collaboration enabled us to pursue the acquisition of Granite State Community Bank, a $150 million asset institution based in New Hampshire that represented a significant expansion in transaction scale and complexity. The target institution served manufacturing communities through 7 branch locations and had established strong commercial lending relationships with regional businesses. Granite State Community Bank faced challenges common to many community banks in manufacturing-dependent markets, including pressure from economic volatility affecting their commercial customers and competition from larger institutions that could offer more sophisticated cash management and credit facilities. However, the institution possessed valuable market presence and customer relationships that could be enhanced through operational improvements and expanded service capabilities. The due diligence process for Granite State Community Bank required more sophisticated analytical approaches than the Berkshire County transaction due to the larger scale and greater complexity of the target institution's operations. The commercial lending portfolio necessitated detailed industry analysis and economic forecasting to evaluate credit quality and growth potential under various market scenarios. The operational assessment revealed opportunities for significant efficiency improvements through technology upgrades and process standardization, while the market analysis demonstrated potential for expanded commercial banking services that could increase revenue per customer and strengthen competitive positioning against larger institutions. The negotiation process with Granite State Community Bank's ownership group proved more complex than previous transactions due to multiple stakeholder interests and sophisticated valuation expectations. The sellers had engaged investment banking advisors and were conducting a formal auction process that required competitive bidding and comprehensive presentation of acquisition strategy and integration capabilities. The proposal I developed for Granite State Community Bank emphasized operational enhancement rather than cost reduction, while demonstrating specific capabilities for preserving local decision-making authority and community engagement that distinguished community banks from regional and national competitors. This strategic positioning differentiated our offer from competing proposals that focused primarily on administrative consolidation and expense reduction. The successful acquisition of Granite State Community Bank in December established my partnership with Margaret Chen as a serious participant in community banking consolidation throughout the Northeast region. The transaction generated substantial returns while demonstrating our capability for executing larger and more complex acquisitions that could create meaningful market presence within regional banking sectors. More importantly, the Granite State acquisition provided operational control over banking assets that exceeded $200 million when combined with our Berkshire County holdings. This asset base provided sufficient scale for pursuing additional acquisitions while generating cash flow that could support expanded acquisition activity without requiring external financing. The integration of Granite State Community Bank proved more challenging than previous transactions due to the size differential and operational complexity involved in combining institutions with different market focuses and customer bases. However, the systematic integration methodology I had developed proved adaptable to larger-scale applications while maintaining the cultural sensitivity necessary for preserving customer relationships and employee engagement. The successful completion of the Granite State integration reinforced my reputation within the community banking sector while providing practical experience with larger-scale operational challenges. The transaction demonstrated that my strategic framework could create value across different institutional profiles and market conditions, while maintaining the community banking principles that represented these institutions' primary competitive advantage. The financial performance of our combined banking operations during the first quarter following the Granite State integration exceeded initial projections and validated the operational enhancement strategies that distinguished our acquisition approach from purely financial consolidation models. The revenue growth and efficiency improvements demonstrated that community banking consolidation could create genuine value through strategic rather than merely tactical approaches. During the spring of my final semester at Wharton, the success of our community banking acquisitions began attracting attention from larger financial institutions and private equity firms that specialized in regional banking consolidation. These inquiries represented recognition that our operational capabilities and market presence had created valuable franchise assets that could support additional growth or strategic partnerships. However, the most significant development during this period involved identification of acquisition opportunities within the Connecticut market that would position our banking platform for eventual influence over the financial institutions serving my family's local community. The research I had conducted into regional banking markets revealed consolidation trends that could create opportunities for strategic positioning within the specific geographic areas where my parents maintained their business and personal banking relationships. Up next, you've got two more standout stories right on your screen. If this one hit the mark, you won't want to pass these up. Just click and check them out. And don't forget to subscribe and turn on the notification bell so you don't miss any upload from us.